Ever wondered about gap trading? It's like a treasure map in the financial world, full of secrets to unearth. Let's delve deeper into its mysteries together. So picture this: the breakaway gap, a strong, sudden shift in price. Like a tsunami wave, it appears abruptly, carries a monstrous force, and leaves the market in a dramatically different state. This is a technical event that often signifies the beginning of a new trend, a sea change in the market sentiment. It's a move that can potentially offer you highly lucrative trading opportunities, if correctly interpreted and acted upon. But the glamour of gap trading doesn't end there. Oh no, we have the continuation gap, a pause in trend momentum. It's the calm before the storm, the quiet moment where traders hold their breath, waiting for the next move. It can be likened to an intermission during a thrilling play. The curtains are closed, the audience is waiting with bated breath, anticipating the next act. But remember, the continuation gap is not a signal to exit. Rather, it's a time to consolidate, to reassess your positions and prepare for movement in the direction of the prevailing trend. Lastly, there is the exhaustion gap. This is the final push before a trend reversal. A last gasp, a dying ember. This gap typifies the climax of the current trend. It's the culmination of the previous market sentiment, where the bulls or bears make their final stand before the tide turns. Its occurrence signals that the time has come, a reversal is imminent. It's a crucial signal for astute traders, alerting them to prepare for a shift in market direction. Now you must be wondering, how does one trade these gaps? It's an art, a science, a game of strategy and anticipation. There are 3 key strategies you can employ: gap and go, where you ride the momentum like a surfer catching a wave; gap fade, where you bet the initial gap move, going against the grain; and gap and retest, where you patiently wait for a retest of the gap level before making your move. Each strategy has its unique set of considerations and applications, and choosing the right one can be the difference between a profitable trade and a losing one. But that's not all. There are considerations to be taken into account. The gap size is crucial. The larger the gap, the more significant the move. Trading volume too plays a critical role. A high trading volume signifies a robust validation of the gap. The final piece of the puzzle is the market context. It's essential to view the gap in the context of the overall market. A gap in isolation can be misleading. It needs to be understood in relation to broader market trends and sentiment. Of course, there are risks involved. Gap trading is not a risk-free strategy. Gaps can reverse quickly, and the tide can turn against you. You can find yourself on the wrong side of the trade. Therefore, it's imperative to manage your risk effectively. Always use stop losses to limit your downside and protect your trading capital. Risk management should be at the core of your trading strategy. Now imagine this scenario. A stock opens with a large gap up. You perceive this as an opportunity and utilize the gap and go strategy. You ride the momentum and the stock continues to climb, netting a handsome profit. Alternatively, consider this. A stock gaps up in a downtrend. This doesn't fool you. You see through the misdirection and deploy the gap fade strategy. You bet against the initial gap move, and as the stock price corrects itself, you profit from the reversal. Intrigued? Then join the Mazuma Master Universe. Subscribe for more wisdom, won't you?